Hey guys, Freaky Finance here. Last week we looked at Viacom CBS, and this week we're taking it back into Canada, though this stock is cross-listed. It's just not as liquid on the US side. Anyway, we're looking at Alimentation Couche-Tard. They just reported on June 30th. I've already talked about this one really quick when I did the quarterly update, so I still own this one. I kind of view this one as for my portfolio anyway, it's a safer play. And the business model is fairly easy to understand, it's just hard to forecast. And that's convenience stores, gas stations, right? And it's simple enough, right? You can visualize it. So they have their three brands in North America where I am. I'm more familiar with these two, Couche-Tard and Circle K. They also have Ingo down here. Footprint map's pretty interesting. So North America is where they have most of their stores and most of their employees, almost 100,000 employees across 9,200 stores. Actually a fair number in Canada, given the population. America is about 10x. On the Europe footprint's very interesting. When I got in is because the France deal pulled through. So Alimentation has been trying to take some initiative into the larger population areas in Europe. You can see currently they're more weighed on the eastern side of Europe. And then on international, these ones are under licensing agreements. They got Egypt, Saudi Arabia, Singapore, Indonesia, Vietnam's right there. So yeah, pretty interesting footprint, Mongolia. And they recently made an acquisition into Hong Kong, which is right there. Anyway, so this is how the footprint looks in its entirety. So one of the things that's very interesting this year is COVID, right? So COVID, you had revenue actually increase in the merchandise, so that's what they'll call, I guess, what we could simplify as food, but it's a lot more SKUs than that, right? That's like your food, and then you have your fuel. And one of the things that's very interesting is that you have a fairly strong decrease in fuel volume throughout the year of COVID, right? And that makes sense. Less people were driving because of the pandemic. So anyway, one of the things that's very interesting, though, you're going to see gross profit increase both on the merchandise side, which is what we think with the revenues increasing. We also see gross profit increase on the transportation side. So they've sold these double-digit declines in revenue, but they've somehow been able to make more money on the remaining sales. So technically, Alimentation was a COVID winner, even though their fuel volumes got destroyed. So it's a very unique situation to be in. Basically, they have two lines, and we'll see this when I go through the numbers in more detail, but I find this snapshot really good on this page, on page 5 of their news release for Q4. You can see they have about 15.8 billion in merch sales for the year, and they had 29.4 billion in transportation fuel revenue. So from the revenue point of view, fuel drives it, but you can see the huge decline, 24% year over year in revenue decline in fuel, again from fuel volumes. But one of the things that's very interesting for fuel is you can see the gross profit down here, these two lines. You can see they actually go up by 3.8%. So when I look at this, so if I just take this number and divide it by this number, I get about 11.4, maybe 11%. And then when I take this number and divide it by this number, I get about 15.4. So gross margins increased by about 40% on the fuel volume. So while they sold 24% less, their gross profit increased by a material amount. Instead of making 11%, they're making 15%. And that's very interesting. Now, we don't know if that's sustainable or if these things will just continue to net out each other. So as volumes come back, does the gross profit go back down? And we'll talk about its relationship with oil in a bit because it came up on the conference calls. Analysts are trying to figure out, because they also have to try to forecast this, right? And so anyway, it's a very unique situation. I had a lot of fun going through this one. Well, I should point out that the gross profit on merchandise is higher. So if I go 5.3 billion into 15.873, I'm looking at least 33%, right? Yeah, but actually right around 33%, maybe 33.2. You can see merchandise revenue up about 8.2% on the year. They do reference larger basket size. And again, these are annual numbers. It has a June 30th cutoff, so technically 2020 has 3 months of COVID in it, whereas this 2021 fiscal year end has the whole year. They reference larger basket size, though they do, like we've seen with other retailers, say Walgreens, less foot traffic. They did mention they're better targeted with data, and we'll talk about the localized pricing and the more SKUs and expanded offerings that they're going for, and appears to be working. So again, you don't know how much of that is noise because restaurants are closed, right? So did sales just pick up on the merchandise side because it was more convenient? Revenue, like I said, down 24% year on year on less fuel volumes. I do have my note there. I already talked about the fuel margins that kind of actually outscaled revenue decline, which is very unique. Anyway, total revenue down 15% on the year due to fuel volume decreases. So basically revenue went from 54 billion to 45.7 billion. So like, oh my god, on the surface, if you just look at the revenue numbers without going into it, you'd be like, this company's in decline. So then you look at the COGS though, and you see COGS are down. God, what is that, $8.8 billion? So actually, while revenue fell, you could see the gross margin dollar actually increased more than 450 million year over year. And even better is that SGA improved by about 80 million. And there's a lot of things going on here. So they actually have 4x in this number as well. You have the wage pressures. And then on the good side, you have better scale and technology. They are actually getting fairly, I think they're pushing the technology aspect of this business. And it's starting to show up in the numbers. And that's what I like. Gains on disposal. So they're always acquiring. So this company is like chronic acquirer. And it tucks it into their existing business. And then it synergizes with it. So I'll just buy the mom and pop convenience store chains and brand them with Circle K. And then they'll also dispose of other ones they don't want. And so lately they've been, last 2 years anyway, they've been putting gains. So whatever they're selling, they're generating accounting gains on, which is also interesting, which means the value of the underlying gas stations are going up over time versus what they have on their books, which could be a hidden angle. I haven't gone through like the property list or anything like that, but that's what this would tell me. Operating margin, so you can see you're pretty much up the GMD plus the SGA favorable variance. 500 million on the year, which isn't a small number on 3.1 billion, right? It's still 500 million, it's not to sneeze at for this company. Interest expense is lower, debt continues to roll off, and reissuance is at lower interest rates, right? Because interest rates are low. So overall, net income's up 14.7%, even though revenue is down 15.4%, which is a weird statement to say, right? The share price is in US dollars because these numbers are reported in US dollars, so this makes it easier for me. So you can see the company did get technically more expensive, but $2.4 billion more expensive, so it's on materially better numbers. And the fully diluted share count continues to go down, so this company does buy back its shares, but it's not the primary focus. Usually they're able to find acquisitions that they can tuck in and continue to grow the company. Balance sheet, it looks really good. They do have $3 billion on cash right now. I think they're actually under leveraged what they normally are, and I think a part of that is because they're expecting the France deal to work out, right? But when it got rejected, then all of a sudden they're sitting on all this cash. That's what I think anyway. Goodwill's up 600 million. They did acquire, I want to say, 400 properties in Hong Kong during the year. It's not shot up Goodwill a bit, but again, it's relatively small, but I'm never a fan of Goodwill. Debt continues to decrease, so the balance sheet was already strong. They do have 1.1 billion in current debt. That's likely going to roll. Well, they'll just use the $3 billion in cash they have. But yeah, retained earnings continues to go unfavorably because they're making more than $2 billion a year in profit. Cash flow looks good. There is quite a bit of depreciation in this business. So you add back depreciation to their net income, you're pretty much getting what the cash flow number is, which is always makes it easy for me, right? So anyway, that's what you can see here. If I just add the 2.7 billion and the 1.3, I'm getting 4 billion, which is pretty much the CFO. So you can see that it's fairly simple accounting. There's some working capital adjustments in there, but nothing big. What else? So CapEx, I didn't include acquisitions. So the free cash flow is slightly misleading because this company does acquire a lot of businesses over time. That's like its main MO with its cash flow. Is not the share buybacks, even though you can see $1 billion this year. And it's not the dividends pays, even though they are increasing the dividend. They're both relative. They're like secondary and tertiary things to their cash flow. In my opinion, anyway, I feel like management is very focused on acquisitions with their cash flow. So I think we're going to keep seeing that. While the cash flow looks high, because it is high, they are using it for acquisitions. But they did, when the share price fell, when the France deal fell, they did take advantage of that and buy quite a lot of shares themselves, which is what you want to see as well. It means they're active and using capital smartly. Like I said, the dividends did increase. I saw one headline that said dividend yield increased 25% or whatever, but increased dividends paid by 25%, which is what they did technically. But again, you can see the numbers are very small, so 25% on such a low number. It's not a big yielding company, so you wouldn't buy this company for the dividend, but they do have one. The metrics again look good across the board. SGA divided by revenue is slightly misleading this time because revenue got destroyed and SGA pretty much stayed flat. It looks worse than that, but the overall profit of the business improved. The greatest unknown to me is the fuel margins and how they come in over time. Obviously this year was really good to me because the company trades at a 15 PE. It kind of tells me that market kind of thinks 2021 will be worse than 2020 in terms of earnings, or at least not growing. And I'm not sure if I agree with that or not, because you should have some type of reopening play on the merch side, because it's not like, foot traffic is down and you're going to have the fuel because domestic travel is going to increase, right, when we open up again. So at the same time, the real question in my mind then is, okay, what are the margins going to be on the fuel? Does it go back from 15% margin to 11% margin? Or does it stay somewhere in the middle as fuel volumes continue to increase? from the low COVID year? That's really the main question on this one. If you're looking to buy right now, my decision is a little bit easier now because I already own it, and I think this company is just going to continue to grow materially. I also believe there's material acquisitions likely in the short term. They have this internal goal, like this 5 year. Every 5 years, they want to double their EBITDA. So anyway, in 2018, they had 3 billion EBITDA. So 5 years from now, 2023, or from then, you have 6 billion target in EBITDA. And basically, all the analysts are saying, well, you're only going to do 4.6 billion. And we'll talk about that analyst session in a bit. But anyway, there's a disconnect obviously there, right? Shortfall of 1.4 billion. They pretty much said they're going to continue to look for acquisitions. So usually half their growth comes from organic and half their growth comes from inorganic. So I'm thinking there's something big in the pipeline, and that's what that 3 billion cash on hand balance sheet's probably also insinuating, right? And if they don't find anything, they'll probably just continue to buy back shares, though. Now the share price isn't as cheap as it was, unless another deal falls through. But I thought the financials look pretty good, especially for the COVID year. And the hardest question is to see is how do you forecast that in the future? All right, so let's jump back to the numbers. So fuel, one of the things that's interesting with fuel is that they're rebranding them. So they take this base site and they convert it to a Circle K branded fuel site. They've also, through the supply chain, they formed a partnership with Musket. And basically, just think of like Costco and bulk buying. You're bulk buying fuel and you're getting cheaper because you're bulking it. So really it's just a scale thing, and if you own the chain for the whole branded fuel site, you get the recognition as well. One of the things that's interesting to you guys, like how much do they actually make from you and me when we go to a gas station, right? How much does the gas stations take on that, right? And you can see for 2021 anyway, this recent year, which was higher, you have fuel gross margin at 35.28 cents per gallon. So for the Americans watching this channel, they make about 35 cents per gallon off you. They were just making 30 cents per gallon off you the year before. In Europe and other regions, they're making 11 cents per liter. So instead of per gallon, it's per liter. For reference, 1 gallon, 3.78. These numbers are fairly comparable. That's why one looks like it's 3x more. It's just really the current or the unit conversion between gallon and liter. And then in Canada, you have, again, similar margin. You can see the margin play out over time, over the last quarters. You can see kind of how it Q1 2020, Q2 2020, and you can see COVID impact starts, right? This is April, May, June of last year. You can see margins shoot up, and that's when oil was really negative. Then you can see them start to come back down, but then all of a sudden tweaked back up again, even though oil started going, like we saw on our energy plays, they've all been doing fairly well. So that's kind of weird, right? Like, why is all of a sudden margin come back up? I mean, the oil's starting to come back up because you would expect the inverse correlation. So this is something to keep your eye on. If this does get disconnect or not, that's very strong for this company. But we'll have to see, right? Maybe this is an outlier and the trend is going to go back down to 25 or 22, right? On the merchandise side, I did want to point out that I thought this was an interesting comment. So Hong Kong, they said because they included Hong Kong in their numbers, their margin actually went down, and they referenced a product mix. And one of the analysts asked them, and they actually said because Hong Kong sales mix is different, they actually sell more cigarettes, which they make less money in terms of margin percentage, which I thought was kind of interesting. Localized pricing is something I'm excited about. So that's the data-centric part of the business. So they are investing in AI and targeting people and targeting pricing. It's not just target marketing, but target pricing for certain areas, which I think is very neat. And I think this is just going to slowly continue to improve the business. You can see there is improvement in gross margin dollars, and we saw that in the numbers. So sales increased and margins increased, and they are increasing their product offerings. So there are different SKUs at different prices at different locations, right, with different priority. I think that's very strong. The acquisition focused on Asia and US, so that's where they're planning to allocate their resources for tuck-ins. And we saw that with the Hong Kong acquisition this year, and they keep mentioning US is probably the best spot for continued acquisitions, which is interesting. They do own 20% of Fire and Flower, so if you're Canadian, you might be familiar with that on the west side of Canada. So yeah, they do have a backdoor in cannabis, though they're interested on the retail side of it, not actually like cultivating or growing it or anything like that. It's the retail aspect. Again, that's probably just a way to get another SKU, right? Another bunch of SKUs that people might want to buy at a convenience store. This one just talks about frictionless stores. They've started to open some frictionless stores kind of as a pilot project. We'll see if that goes anywhere, but that's kind of where the future's going. Right, no cashier, especially with minimum wage pressures. I mean, it just solidifies the idea of the investment outlay into automation, right, and frictionless payments. I did find this interesting. During this upcoming year, the special voting rights of the founders are set to expire. And then this was fun too on the side. So they have, like I said, they kind of churn, they buy acquisitions and they sell off less strategic ones, probably ones that they're not making as much money. Or in this specific case down here, they were actually making decent money on these properties, but someone was willing to come in and buy them at very high valuations. So these, we mentioned 2 stores in Toronto, Canada. Toronto property prices have gone well over the last 10 years. Not sure when the company bought them, but given the gain, that means they only had them on the books for about 19 million and they were able to sell them for 86 million. So it tells you the appreciation of the gas station. I can't imagine a gas station is easy to convert to something else that's not a gas station, but I'm not a pro on that. But it's kind of interesting, right? That's just a side angle that they can constantly churn stations, and if there's appreciation in underlying property value, they can also sell them out, get more cash, and then reinvest it back in the business and get more acquisitions. So it's kind of a cool cycle. I thought the conference call notes were interesting. They're committed to their data-centric convenience business. It's one of their top strategic initiatives. Our store-by-store pricing, so localized pricing. They're seeing an improvement in gross margin dollars, and they're expanding in scope SKUs. And then the next, they're going to focus on optimizing assortment and promotional activities, so marketing on a local store level, which is kind of cool, but it's what you'd expect. I already mentioned they're rebranding quite a few stores. So they did 450 this year, they're doing 800 this next year, and they claim that the conversions dramatically increase brand awareness, which is true, and they improve underlying costs and give us the ability to control and simplify the customer journey. They didn't actually break out how much extra cost they pull out by owning the branding for the whole vertical, but I digress there. It would have been nice to see. You can see they are doing some, so electronic vehicles are coming, right? And obviously a gas station, you're like, okay, has a limited run rate, but they are starting to do EV in Norway, so they are already starting to do that shift. And again, I don't know what the margins are though. Like, how are the margins looking? Are they still going to be able to make 11 cents per liter equivalent, right? Or 15 cents per liter equivalent? I don't know. So that's something down the pipe. So this guy just asked about the businesses that they sold, and basically saying, yeah, these sites were not strategic to us, so we sold them. And we're also optimistic on some of our high value sites that were worth more to our buyer than it would have been for our operations. So we elected to divest some of those. So that's literally referencing the 2 Toronto things that we saw on that 10K. So this question is pretty interesting. So basically he's asking, so like I said, they have that double every 5-year goal in EBITDA, and he's basically saying, yeah, the analyst expectations are 4.6 billion. Do you still think you're going to do 6 like you said you would? And then his statement's interesting, right? He's like, well, our 5-player plan was to accelerate organic growth to about 50% of our annual revenue growth, or EBITDA growth, with the remainder being M&A. And he says we are on the right track to deliver the organic growth rates we planned. So they're on track on the organic side, but I think they really did want that French deal that got blocked. It's interesting, right? So that's why they referenced that they expect to grow about 50-50 organic, 50 inorganic. Basically, he's saying, well, I don't know, this could be right, assuming they don't do an M&A deal. That's how I translate that. But I just view it as likely that they are going to do a material M&A deal at some point in the next bit. And we don't know how the share price will react to that. If the market thinks they overpaid for it, share price could go down, which would get me excited, because this company has been constantly able to take in gas stations, brand them, and do all the synergies with them, increase the margins on the underlying profitability of the company. Basically, they just improve on the asset they buy, and they're very good at it. That's like their business model. They did offer, I didn't talk about this, but they did do the fresh food fast offer. It's been doing good. A part of that, I think, is because they're taking advantage of restaurants that are closed. So this question is very interesting. So this was a question relating to the correlation between their fuel margins and oil prices, because we saw the margins improve dramatically when oil was getting hammered. And so this analyst is like, well, your numbers in Q4, your margins actually stopped decreasing even though oil was kind of ripping, right? So they're asking, hey, what's going on? There's a disconnect for this quarter. And so the CEO's answer is very interesting. So he says, I believe fuel retailers in general have been focused on maintaining gross profit dollars in the face of rising tobacco pressures. As we know, when we did the tobacco company, that volumes for tobacco products continue to decline, right? And then he says this statement right after, as if this explains the retention of fuel margins. And depending on how you take that answer, you could be like, okay, well, it's like collusion, right? But it's a very interesting thing, right? So really, the main thing with this company is, okay, so margins increased from the low oil prices, and so far they've started to come back down, but they've kind of leveled off at an overall higher level, and we don't know if that's sustainable or not. And if that is sustainable, that higher margin, then this company looks even better, even if it doesn't make any acquisitions. So it's if that's true, if they're like, okay, well, there's just a lot of pressure, right? So what could happen is, as volumes increase, as domestic driving increases, that's how I view this answer: is domestic driving increases, fuel volume should increase, and therefore the convenience store gas stations don't charge as much or make as much a margin because they're making it up in volume instead. But it tells you that they have this would tell me that they have pricing power, right? Or at least that's how I translate it. Anyway, I thought this answer was kind of cool, right? It's like, whoa, And so this guy asked us the merch, because merch was doing so good on year over year for same store growth. He talks about the merchandise pricing and the promotion work, like the localized pricing. And then they talked about the strong performance in nicotine categories. And this was the very interesting time, because remember we did the British tobacco video. He said this non-combustible margin dollars have exceeded combustible, so traditional cigarettes, in some of our key markets for the first time. That does say people are switching from tobacco to non-combustible. So that's pretty interesting. And yeah, they did do their fresh food fast initiative. And then, yeah, just for reference, I thought this comment was interesting. We all know that 50% of the trips in our industry are focused on beverage and satisfying a first need. So really convenience, and that's why the margins are so good, right? Like 30% margin on food, right? Because it's more just if it's there and you want it now kind of thing, kind of like impulse buying. So this one just talks about M&A and specifically Asia. And he says, we didn't buy that company to have just 400 stores in Asia. It's part of a long-term commitment to try to grow that part of the region. So that tells you where they're thinking about using their cash flow. He did mention this interesting as well, because there's some overlap with the tobacco company, which is interesting, right? Because British Tobacco also mentioned Vietnam for sales increases in tobacco. So it's kind of interesting to see this again, where this company also mentions Vietnam, where we have an emerging class with disposable income, which leads to modern retail meets the convenience. I thought that was an interesting statement. And then this guy asked about the fuel margin outlook for the year, because they have to try to analyze and forecast this, right? So, and again, his answer is very interesting. So it's like over the last decade, you'd keep consistent rise in unit margins for the industry. Underlying this is the need to generate a level of return in the face of cost pressures, declining cigarettes, and again, now fuel volumes. So it's basically saying because they're making less in other places and there's pressures, like wage pressures and stuff like that, they increase their prices and therefore increase their margins, which technically makes sense, but it tells you that they have the power to do so, right? And that also makes sense because we're likely to pay whatever price is at that pump, right? Unless it's something outlandish, where we'll drive to the next pump over, assuming they don't all collude together. But anyway, that's why they've slowly been increasing the margins over time on the fuel side. But yeah, it's kind of a pretty interesting company anyway. I kind of view it as an easier one to understand. You can see though, during the COVID panic, this stock got hit pretty hard, even though technically we saw the numbers for the COVID year were actually superior. So you can see the panic, and then the market quickly rejected in about 2 weeks, back to 40, right? And then this was when I got in. This is when I started looking at it, because I was like, oh, I missed the move, right? And then I looked at it here. This is when the French deal pulled through, and I pulled the trigger on it. So that's why I don't think I got in perfectly. What am I at? 37.6. Oh, I did. I got pretty good anyway. But yeah, it was on this day with all this huge volume. People were just selling like crazy. And I'm like, is the company really worth that much less because they didn't get the deal it wanted in France? I don't think so. And we can see in the numbers that they're just killing it. So anyway, currently it's because of the last June 30th report. It's kind of gone up a bit again. But in my mind, you're at 15 times PE. It looks pretty steady, so I'm going to be holding this one for a while. Again, it's not a dividend payer or anything like that. It's just a chronic grower. It keeps using its cash flow and reinvesting into new gas stations and growing and growing and growing. And they did buy back quite a lot of shares. $1 billion isn't a small amount for a $40 billion market cap company, right, in a year. So anyway, I'd like to know your thoughts on Alimentation Couche-Tard, and have a good rest of your week.